I need to tell you something that's hard to say. I was wrong about silver. Not completely wrong, not about the long-term fundamentals, but wrong about the timing and wrong about how the next move would unfold. And over the past few weeks, three pieces of data came across my desk that fundamentally changed how I'm thinking about this market. And when the data changes, you change your mind. That's not weakness. That's how you survive in markets. So I'm going to walk you through what I got wrong, what new information shifted my view, and what that means for how I'm positioning now. Because if you're holding silver or thinking about it, you need to see what I'm seeing. And you need to understand why admitting you're wrong is more valuable than pretending you're always right. Right now, as I'm recording this, comment when you're watching, because if you're seeing this in real time, you can track whether the data I'm about to show you continues to develop or if it reverses. And if you value transparency over ego, if you want analysis that evolves with the data instead of defending a predetermined narrative, subscribe and comment FinTalk OG so the algorithm knows you're here for intellectual honesty. Now, before I tell you what changed, let me tell you what I got wrong. A few months back, I was cautious on silver in the near term. My view was that after the spike to 121 and the subsequent crash back to the 70s, we'd see an extended consolidation. I thought physical premiums would compress as dealers restocked. I thought COMEX delivery stress would ease as open interest rolled forward. I thought industrial demand would soften as manufacturing data weakened. And I thought we'd chop sideways for months, maybe quarters, before the next leg up. That was my base case. I wasn't bearish long term. But I thought we had time. I thought the next catalyst was distant. I was wrong. Here's what changed my mind. Three specific data points that emerged over the last few weeks that I didn't anticipate and that fundamentally alter the supply-demand picture. Data point 1. Refining capacity constraints are worse than I thought. Data point 2. Industrial demand is not softening, it's accelerating in specific sectors that I underestimated. And data point 3. The pace of central bank and institutional accumulation of physical silver has not slowed after the crash. It's increased. Let me walk through each one and show you why it matters. Data point 1. Refining capacity. I've covered the China refining controls and the Mexico export restrictions in previous videos. But what I underestimated was the time it takes for Western refining capacity to respond. I assumed that if Chinese refined silver was restricted and Mexican silver was harder to export, Western refiners would just ramp up. More shifts, more throughput. Problem solved within a few months. I was wrong. Refining capacity doesn't scale that fast. It's not like flipping a switch. Refiners need feedstock. They need permits. They need labor. And they need capital to expand. And recent industry reports from major refining hubs in the U.S. and Europe show that lead times for refined silver products have not compressed. They've extended. Here's the specific data that changed my view. Multiple large North American mints reported in recent updates that their delivery windows for bulk orders are now running 10 to 14 weeks. That's up from 6 to 8 weeks a few months ago. Why? Because they can't get feedstock fast enough. Refiners are running near capacity, but the bottleneck is at the input side. They need door bars. They need scrap. They need raw material. And with Mexico restricting exports and China prioritizing domestic supply, the Western refiners are scrambling to source material from secondary markets. That takes time. And it costs more. So refined silver in the West is not becoming more available. It's becoming less available. And that's showing up in persistent elevated premiums and lengthening delivery times. I thought this would resolve in Q1. It hasn't. And the more I dug into refinery data and talked to people in the supply chain, the more I realized this is a structural bottleneck that's going to take a year or more to work through. Not weeks, not months, a year. That changes the timeline for when physical supply loosens. And if physical supply stays tight for another 12 months, that's a floor under prices that I didn't account for. Data point 2. Industrial demand. I was looking at broad manufacturing PMI data, ISM reports, and general industrial activity, and those numbers have been mixed to weak in parts of the developed world. So I assumed silver's industrial demand would soften. But what I missed was the sector-specific demand that's not just holding up, it's growing aggressively. Specifically, data centers and AI infrastructure. I knew this was a demand driver. I covered it. But I underestimated the scale and the urgency. Here's the new data. Recent reports from major cloud infrastructure companies and data center builders show that silver consumption per facility is significantly higher than previous generations of data centers. Why? Because AI workloads require vastly more computational power, which means more servers, more chips, more cooling systems, more power distribution, and all of that requires silver. Connectors, switches, thermal interface materials, power contacts, it all uses silver. And the build-out is happening at a pace that's faster than anyone projected even 6 months ago. One report I saw estimated that data center-related silver demand could increase by 30 to 50% year over year for the next 3 years. That's tens of millions of ounces of incremental demand that wasn't in the models a year ago. And it's not just data centers. Solar installations are also running ahead of previous forecasts. Recent government energy data from multiple countries shows that solar capacity additions are exceeding targets. Each gigawatt of solar requires silver. And while the amount of silver per panel has been declining due to efficiency improvements, the sheer volume of panel installations is more than offsetting that decline. So net silver demand from solar is still growing. I was too conservative on industrial demand. I thought it would flatten or decline. The data now shows it's growing faster than expected in the sectors that matter most for silver. And that demand is sticky. You can't just stop building data centers or solar farms because silver prices go up. These are multi-year projects with locked-in budgets and strategic importance. So that demand is going to keep pulling on supply regardless of price. That's bullish. And I didn't give it enough weight. Data point 3. Institutional accumulation. After the crash from 121 to the 70s, I expected institutional buyers to back off. I thought they'd take profits, de-risk, move to the sidelines. I thought the crash would scare away momentum money and we'd see a period of lower institutional interest. I was completely wrong. What actually happened is the crash created a buying opportunity for institutions that understand the long-term thesis, and they stepped in aggressively. Here's the evidence. COMEX warehouse data over the last several weeks shows that registered silver inventories have not stabilized. They've continued to draw down, not at the panic pace we saw during the delivery squeeze setup, but at a steady, consistent pace. That tells me someone is taking delivery. And it's not retail. Retail doesn't take COMEX delivery. It's institutions. Bullion banks, ETFs, large funds, entities that are accumulating physical metal and moving it out of the exchange system into allocated storage or private vaults. Additionally, if you track the flows into physical silver ETFs like PSLV, you see net inflows over the past month, not massive but steady. That's institutional money. Retail tends to panic sell after crashes. Institutions accumulate on weakness. And that's exactly what the data shows is happening. The crash didn't kill institutional demand. it activated it. And then there's the anecdotal data from dealers. I've been tracking dealer commentary and industry reports. Multiple large dealers have said that after the crash, they saw a surge in orders from high net worth individuals and family offices. Not speculative flips. Long-term accumulation. People who want physical bars in size and are willing to pay premiums and wait for delivery. That's not weak hands. That's smart money positioning for the long term. And I didn't expect that behavior after a crash. But it's happening. And it tells me the thesis is not broken. It's being validated by the people with the most capital and the longest time horizons. So when you put those three data points together, refining capacity tighter than expected, industrial demand stronger than expected, and institutional accumulation continuing despite the crash, the picture changes. I thought we had time. I thought the next move was 6 to 12 months away. I now think the window is tighter. I think we're setting up for the next leg higher sooner than I anticipated. Not in days or weeks, but in months. Q2 or Q3 could see a meaningful move. And I wasn't positioned mentally or strategically for that timeline. Now let me be clear about what I'm not saying. I'm not saying silver is going to 200 tomorrow. I'm not saying there's a guaranteed squeeze. I'm not saying you should lever up and go all in. What I'm saying is the data has shifted my probability assessment. I was 60-40 that we'd chop sideways for most of the year. I'm now 60-40 that we see a sustained move higher within the next few months. That's a meaningful shift, and it changes how I think about position sizing, entry points, and risk management. Here's how my positioning has changed. Before, I was comfortable holding a core position, but not adding. I was waiting for lower prices or more clarity. Now, I'm adding on any pullback to the mid-70s. If silver drops to 74, 75, I'm a buyer, not aggressively, not all at once, but scaling in, because the risk-reward has shifted. The downside feels limited given the physical tightness and the industrial demand floor, and the upside feels more probable given the data I just walked through. Second, I'm adjusting my time horizon. I was thinking 12 to 18 months for the next meaningful move. I'm now thinking 3 to 6 months. That doesn't change my long-term thesis, but it changes how I manage the position. I'm watching more closely. I'm tracking the weekly data more tightly. And I'm prepared to add or trim based on how the next few months develop. Third, I'm putting more weight on physical over paper. I already favored physical, but the refining bottleneck data reinforces that. If you own physical silver, you own an asset that's becoming harder to source. The premium you paid is looking smarter. If you're in paper, SLV, or futures, you're exposed to price but not to the physical supply tightness. And in a market where the physical premium is expanding, physical outperforms. So I'm biasing any new capital toward physical or physically backed products like SLV. Now let's talk about what could still go wrong. Because just because I changed my mind doesn't mean the new view is guaranteed to be right. Here are the risks. Risk 1, a macro shock. If we get a major credit event, a financial crisis, or a sharp recession, everything sells off, silver included. Physical tightness doesn't matter if liquidity drains out of the system and forced sellers have to dump positions. I don't think that's the base case, but it's a tail risk. And if it happens, silver could test 60 or lower before bouncing. Risk 2, demand destruction faster than I expect. If silver prices spike to 120, 150, 200, industrial users will accelerate substitution efforts. They'll redesign components, they'll find alternatives, and that could cap the upside or even reverse demand. It takes time, but it's a real risk at higher prices. Risk 3, a resolution of the supply bottlenecks faster than expected. if China suddenly reverses their refining restrictions, if Mexico opens the export taps, if Western refiners bring new capacity online in months instead of years, then the physical tightness thesis weakens. I don't think this is likely based on the data, but I've been wrong before, so I'm watching for it. Risk 4, institutional positioning shifts. Right now, institutions are accumulating. But if something changes, policy, geopolitical developments, alternative investment opportunities, they could rotate out of silver fast. And when institutions sell, they move size. That could overwhelm retail demand and push prices lower. It's a lower probability risk given current trends. But it's on the list. So I'm not blind to the downside. I'm just saying the probability distribution has shifted in a way that favors the upside more than I thought a few months ago. And when probabilities shift, you adjust. You don't dig in and defend the old view. You update. Here's what I want you to take from this. First, it's okay to be wrong. In fact, it's required if you're going to survive in markets. The best investors and traders are the ones who update their views when the data changes. The worst are the ones who marry a thesis and ignore contradictory information. Don't be that person. If you were bearish on silver and the data shifts, update your view. If you were bullish and the data turns against you, adjust. Flexibility is an edge. Second, watch the data I'm watching. Refining lead times, industrial demand reports from data center and solar sectors, COMEX registered inventory trends, physical ETF flows, dealer commentary on high net worth buying. Those are the signals that matter, not headlines, not Twitter hype, not talking heads on TV, the data. Track it yourself, and when it shifts, adjust. Third, position size matters more than being right. Even with my updated view, I'm not betting the farm. I'm adding incrementally. I'm managing risk. I'm using pullbacks to scale in, because even if I'm right about the direction, I could be wrong about the timing or the magnitude. So I'm sized in a way where I can be wrong and survive. And if I'm right, I still participate. That's the game. Fourth, physical silver is looking better relative to paper. The refining bottleneck is real. The premium you pay for physical is insurance against exactly this scenario. If you're accumulating for the long term, bias toward physical or allocated storage. If you're trading for short-term moves, paper is fine, but understand what you own and why. Here's my final take. A few months ago, I thought silver would chop sideways for most of the year. I thought the next big move was distant. New data changed my mind. Refining capacity is tighter. Industrial demand is stronger. Institutional accumulation is ongoing. And the timeline for the next leg up feels compressed. I'm now positioned for a move higher in Q2 or Q3. Not guaranteed, but more probable than I thought. And I'm adding on weakness and watching the data closely. If you disagree, tell me why in the comments. If you see data I'm missing, share it. If you think I'm still wrong, make the case. Because the goal here isn't to be right. The goal is to get closer to the truth. And that requires testing ideas, updating views, and being willing to admit when the data shifts. Tell me in the comments, have you changed your view on silver recently? And if so, what data point or event shifted your thinking? I want to see how the community is processing the same information, because often the best insights come from the collective, not from one person. If this breakdown gave you permission to change your mind when the data changes, subscribe and comment FinTalk OG, and share this with someone who's been stuck in an old thesis and needs to see that updating your view is a strength, not a weakness. One last thing. This is my updated analysis based on recent data. It's not a recommendation to buy, sell, or trade anything. I could be wrong again. The data could shift again. Markets are unpredictable. Use this as one input into your own decision-making process. Manage your risk. Know your time horizon, and only invest capital you can afford to hold through volatility. All right, stay flexible, follow the data, and I'll see you in the next one.